Big tax changes are coming to Canada in 2026. Here's what you need to know. If taxes already feel confusing, stressful, or like something you just hope will work itself out, you're not alone. Most Canadians don't think about taxes until the deadline hits, and by then, it's usually too late to change anything. But 2026 is shaping up to be an important year for taxes in Canada. Not because everything is suddenly brand new, but because small changes are adding up, and those changes can quietly cost you money if you don't pay attention. Today, I want to walk you through what's being discussed, what's already changing, and what you should understand about things like RRSPs, TFSAs, tax brackets, and basic personal amounts. I'll give you clear explanations so you can make better decisions with your money. Thank you for stopping by today. I'm Awa, a financial advisor in Canada, and I help people like you build a stronger relationship with money by making personal finance simple. So, if you're serious about improving your finances, hit that like button and subscribe for more content like this. Let's get started. So, here's the truth. Even if tax rules don't change dramatically, inflation acts like a hidden tax. If your income goes slightly but your tax bracket don't keep up properly with rising costs, you could end up paying more tax while still feeling poorer. That's why paying attention now matters. Taxes don't just affect rich people or business owners. They affect your paycheck, your savings, your retirement, your ability to get ahead. And most people don't realize that until they feel stuck. First, let's start with tax brackets because this affects everyone who earns income in Canada. Canada uses something called the progressive tax system. That sounds complicated, but it's actually very simple. A progressive tax system means the more money you make, the higher the tax rate you pay on the extra income, not on all of your income. You are not taxed at one flat rate on everything you earn. Think of your income like buckets. Each bucket is taxed at a different rate. When one bucket fills up, the extra money spills into the next bucket and gets taxed at a higher rate. For example, if you earn $60,000, you don't pay the same tax rate on all $60,000. The first portion of your income is taxed at the lowest rate. The next portion is taxed at a higher rate. Only the money that falls into the higher bracket is taxed more and not the entire amount. This system exists so that people with lower incomes pay lower tax and people who earn more contribute more without punishing everyone equally. And this is where tax brackets come in. For 2026, the federal tax bracket has been updated for inflation. That means that the government adjusted the income ranges so that people don't end up paying more taxes just because prices and wages have gone up. Here's what the federal rates look like for 2026. 14% on the first $58,523 you earn. 20.5% on income over $58,523 up to $117,045, and 33% on anything over $258,482. That's just the federal portion though. Remember, each province also adds its own tax on top, so your total tax is a combination of both. Here's an example. If you make $60,000 in 2026, you pay 14% on the first portion of that income and 20.5% on the rest of the $60,000. Combined with your provincial tax, that's how your total annual tax bill is calculated. Next up is the basic personal amount, or BPA. This is the amount you can earn before you owe any federal tax. In 2026, the BPA goes up to $16,452 for most Canadians. That means that if you make $16,452 or less, you'll pay zero federal tax on that income. If you make more than that, you still get the BPA as a tax credit. It just reduces the amount of income that gets taxed. For example, if your taxable income is $50,000, the first $16,452 isn't taxed at the federal level. That's like giving you a cushion before your tax bill starts. This is helpful especially for people who are working part-time, students, or anyone trying to keep more of their hard-earned money in their pockets. Next, let's talk about RRSPs, which stands for Registered Retirement Savings Plans. These are one of the most powerful tools for reducing your taxable income. When you contribute to an RRSP, you lower your taxable income for that year. You get a tax refund, and your contributions grow tax deferred until you withdraw at retirement. For 2026, the RRSP contribution limit is $33,810. That's the maximum you can contribute based on your income from the previous year. So, if you earned $60,000 in 2025, your RRSP room for 2026 will be 18% of that, up to the maximum of about $33,810. Here's a simple example. If you contribute $5,000 to your RRSP in 2026 and you're in a 20.5% tax bracket, you could save around $1,025 in federal tax this year. RRSPs are especially useful if you're currently in a higher tax bracket and expect to be in a lower one in retirement because you pay less tax when you withdraw it. Now onto the tax-free savings account. TFSA. A TFSA or tax-free savings account is available to anyone who is 18 or older and has a valid social insurance number. You don't need to be a citizen and you don't need to be a permanent resident. As long as you are considered a resident of Canada for tax purposes, you can open and contribute to a TFSA. For immigrants, this is really important. Your TFSA contribution room does not start when you arrive in Canada. It starts the year you become a resident for tax purposes. So if you landed in Canada in 2023, your TFSA room begins in 2023 and not before. So that means that you don't automatically get all the past year's TFSA room. And one more big mistake I see all the time. If you contribute while you are not a resident for tax purposes, the CRA can charge penalties. The TFSA remains one of the best places to put your savings or investments because you never pay tax on growth or on withdrawals. For 2026, the TFSA annual limit is $7,000, just like it was last year. If you've been contributing since 2009 and never missed a year, you may have up to about $109,000 in total contribution room. Here's why that matters. If you save or invest in a TFSA, say you buy stocks or an index fund, all the interest, dividends, and gains are completely tax-free forever. For example, if you put $7,000 in your TFSA and it grows to $10,000 over time, you never owe tax on the $3,000 gain. That's huge compared to a regular investment account where you pay tax on gains each year. Apart from RRSPs and TFSAs, there are two deductions that affect almost every working Canadian, whether you notice it or not. I'm talking about the CPP and EI. These come straight off your paycheck, so it's important to understand what you are paying and what you actually get in return. Let's start with the CPP, which is the Canada Pension Plan. CPP is essentially a forced retirement savings plan. Every time you work, you contribute a portion of your income into a CPP and your employer matches it. In 2026, CPP contributions apply to income up to $68,500. The contribution rate is 5.95% for employees. So if you earn $60,000 a year, you'll contribute around $3,570 to CPP for the year. And your employer puts in the same amount. That money doesn't disappear. It goes towards your future retirement income. And when you retire, CPP pays you a monthly pension for life based on how much or how long you have contributed. The maximum CPP retirement benefit at age 65 is a little over $1,300 per month, but most people receive less because they didn't earn the maximum every year. CPP isn't meant to fully fund retirement. It's meant to be a base, which is why personal savings still matter. Now let's talk about EI, employment insurance. EI is not a savings plan. It's an insurance program. You pay into it while working so that if you lose your job through no fault of your own, or you need maternal, parental, or sickness benefits, you have temporary income support. In 2026, EI applies to earnings up to $68,900, and the employee premium rate is roughly 1.63%. That means that if you earn $60,000, you pay about $978 per year into EI. Your employer also contributes usually about 1.4% what you pay. If you lose your job, EI can replace up to 55% of your income, up to a weekly maximum. It's not your full paycheck, but it helps you survive while you look for work or recover from illness. The key thing to understand is this: CPP helps future you and EI protects present you. Both reduce your take-home pay today, which can feel frustrated, especially when money is tight, but they also exist for a reason: to reduce financial shock later in life, whether that's retirement, job loss, or unexpected time off work. These deductions usually increase slightly over time to keep up with wages and inflation, which is why people notice them more now than they did years ago. So why should you care? If you work and earn a salary, your tax bracket determines how much money you get to keep after taxes. If you save for retirement, knowing RRSPs versus TFSAs help you keep more money over the long run. If you earn less income, the higher basic personal amount means you might pay less tax overall. Taxes aren't just a number. They affect your monthly budget, your goals, your retirement, and your overall financial health. Let's wrap this up. Canada's 2026 tax changes include updated tax brackets, a larger basic personal amount, and continued TFSA and RRSP contribution limits. Whether you're working, saving, investing, or planning your future, these updates matter. Thank you for watching. If this video helped you understand your tax situation better, hit that like button, subscribe for more money videos, and comment below. Until next time.